All right, let's talk about something you hear all the time in crypto, the fair launch. It's a term that gets thrown around constantly, but what does it really, truly mean? Today, we're going to peel back the layers on one of the industry's biggest promises and see if it actually holds up. I mean, this is the dream, isn't it? It's this beautiful idea of a level playing field where a new protocol just appears and everyone, literally everyone, has the exact same opportunity. It's such a powerful concept, but as we're about to see, the reality is, well, it's a lot messier.
So, just so we're all on the same page, this is our starting point. This is the ideal. A true fair launch is all about total equality. No backroom deals, no early allocations for the team, no special treatment for insiders. It's supposed to be simple, pure, and, well, fair.
And that really is the million-dollar question, isn't it? Has this core principle, this foundational idea, been so watered down over the years that it's now just a buzzword? A marketing tactic to make you feel good about a new token, even if the launch is anything but fair? Let's find out.
You know, you can't have this conversation without starting at the beginning. We have to talk about the project that's always held up as the gold standard of a fair launch, Bitcoin. But was it really as fair as everyone seems to think?
So let's put it to the test. You hear it all the time. No VC round, no presale, no foundation treasury. And yeah, all of that is true, but that's not the whole story, not by a long shot.
Now this is where it gets really interesting, when you put the myth right next to the reality. For that first year, Satoshi had an absolutely massive amount of control over the network. And because so few people were mining, it was basically a pre-mine for a tiny, tiny group of people. And get this, the halving mechanism itself is designed to create wealth inequality over time. It literally guarantees that people who come in later can never be on equal footing with those who were there at the start.
So why does Bitcoin get a pass for all this? Well, the big reason is that Satoshi never sold his coins. There was no giant insider dump that tanked the market. But the fixed supply, the very thing that made it scarce and valuable, also kind of killed its original dream of being peer-to-peer cash. It became digital gold instead, with that inequality baked right in from day one. So even the so-called fairest launch had some pretty deep structural problems.
Okay, let's fast forward about a decade. If Bitcoin's launch wasn't perfect, what happened when the idea of a fair launch made a huge comeback? Let's jump to 2020. To the infamous DeFi Summer, when this concept suddenly became super trendy again, but with a totally new meaning.
So in this era, you had projects like Yearn Finance saying they had fairly distributed tokens because anyone could farm them by providing liquidity. Now, farming liquidity sounds really complex, right? But it basically just meant lending your crypto to a project. The problem? This wasn't some open-to-everyone activity. It was a high-stakes financial game that massively favored the people who already had tons of capital to play with. And this is how the whole system was gamed. It led to this crazy phenomenon called a vampire attack. A new project would just copy the code from a successful one, promise ridiculously high rewards, and literally suck all the money out of the original. The insiders on the new project would get insanely rich, and then the whole cycle would just start over. You tell me, does that sound fair?
And that's really what it all came down to. The term fair launch got completely stripped of its original meaning. It just became a way to say, hey, at least we're not one of those sketchy ICOs from 2017. The core principle of equality, yeah, that was pretty much gone.
Which brings us to today, the modern era, where the goalposts for what we call fair have moved, again. Now the pre-sale model is pretty much the standard for how you launch a big new blockchain.
Ethereum really wrote the playbook for this. It raised an incredible $18 million by selling off a huge chunk of its supply before the network was even running. And that exact pattern was copied by pretty much every major chain that followed. Solana, Aptos, Sui, all raising hundreds of millions and giving huge allocations to insiders. So today, a project can call itself a fair launch, but when you look under the hood, the token allocation looks something like this. You see a massive piece of the pie, sometimes over a third, just locked away for the team and the early investors. And what that really is just delayed inflation that's going to hit the market down the road.
Man, this quote just hits so hard because it's so true. In this pre-sale world, the money coming in from the public, from new users, it's not just funding the project. A lot of the time, it's just being used to give the venture capitalists and insiders who got in super early a way to cash out.
So the bottom line is the entire definition has been completely warped. Fairness doesn't mean zero insiders anymore. Now it just means a tolerable number of insiders, maybe 5% or so.
The original idea of total equality has been totally compromised, and we've all just kind of accepted it as normal.
Okay, so we've spent a lot of time tearing down what a fair launch isn't. So let's try to build it back up. If the way we've been using the term is broken, what should a true, genuine fair launch actually look like?
Here's a brand new way to think about it, a new test for fairness. It's not about what percentage insiders get, it's about one simple, ongoing question. Does the network reward the same amount of work with the same amount of value no matter when you do it? Day 1 or year 10? Equal contribution should mean equal reward.
And this gives us a really simple, practical checklist you can use for any project. Can anyone actually contribute, or is it just for people with a lot of money? Are the rewards actually equal over time? Is the insider allocation at the network level truly zero? And is all the inflation happening out in the open, on-chain, with no secret vesting schedules that are going to dump on the market later?
And this is the final, crucial piece of the puzzle. In a genuinely fair system, the network's value has to come from what it can actually do, its utility, not just from people speculating on the token price. Founders should get rich by building amazing things on top of the network, not by just cashing out the tokens they got for free at the start.
So I'll leave you with this final thought. If any network that gives special treatment to insiders can eventually be copied and replaced by one that's a little bit fairer, then maybe true, absolute fairness is the only foundation for a network that can actually last. And if that's true, when you look around at the crypto space today, how many of these projects are really built to stand the test of time?